Earnings season has kick-started with TCS. There you go. The numbers at the bottom of your screen. The first number is the PAT number, which is coming, which is 10,850 crores. It's about a 250 odd crore miss than what the street was anticipating. Just to clarify, it's the agency number that we are putting out now. The release should come in the next 1 or 2 minutes or so. So I think that is the time when we'll get more details coming in. Consolidated PAT is about 10,850 odd crores. So I think that's the number which the street will go with. The initial number in terms of a dividend is coming at 8 rupees, a special dividend of 67. Okay, Anisha is there with us. Anisha, do you have more details? We have PAT numbers of 10,850 crores. That's a consolidated PAT number. I'll give you more details, but first reaction, expectations was 11,000 crores.
Oh, well, yes. And I think on the revenue front, though, the company has done okay at 58,229 crore. The miss has actually come at the EBITDA level because the operating margin has come in at 24.5%. And that's the reason you are seeing that miss as far as bottom line is concerned. It's not a big miss, but still a miss coming in there. And the margin profile street was banking a lot on. The expectation was that at least margin this time around is going to be the stellar thing. But that's not happening this time around as well. And even if you look at the headcount addition is actually negative, which means that on a net basis, the headcount has actually gone down. The attrition also remains at 21.3%, so there hasn't been a significant cool off because the attrition last quarter was around 21.5%. This time around it has come in at 21.3%. What commentary is coming in from the management, wherein Rajesh Gopinathan says that they are pleased with the strong performance in a seasonally weak quarter, and they are saying that they have seen market share gains through vendor consolidation. Now, this is something that the street wanted to hear because vendor consolidation is something that is going to pan out for the sector as well. And they talk about continued momentum in the North America and UK business. So there's no slowdown at the moment, at least in North America. Plus UK is something which is looking good to them. Rajesh Gopinathan also adds that looking ahead, beyond the current uncertainties, their longer-term growth outlook remains robust. I'm looking in for more details as well, but at the moment, these are the key ones that I have. The net operating margin is a miss. The revenue looks okay, but I'll wait by and see what the constant currency growth is, because I don't have that number yet. On the bottom line, a bit of miss, but headcount addition is a bit, muted. And even if you look at the order book at $7.8 billion, it's a tad bit lower than expectation. I'll give it back to you, Pankaj. In the meantime, I'll look for more details.
We'll just get more details coming in, as Anisha said. The operating margin coming in at 24.5%. That's a contraction of 50 basis points on a YOY basis, and that's probably the reason that she's saying that numbers are looking the way they are. Rajesh Gopinath says, and I quote from the press release, that we are pleased with our strong growth in seasonally weak quarter, driven by cloud services, market share gain through vendor consolidation, and continued momentum in the North America and UK. The sustained strength of demand for our services and validation for our value we provide our clients in helping them differentiate themselves. Omkar is with us on the phone line. Omkar, first reaction. Revenues higher than anticipated, but I think what is your first reaction to operating margin of 24.5%?
Yeah, I mean, it is much in line with an expectation. It's a positive news in terms of revenue. It shows the resilience in terms of the demand scenario. In case of the margins are likely to be in line and in line with the expectation in some sort of a moderation. But the major things that one should look upon, the order book still remains strong. We were expecting some softening of the order book for the quarter, but looks to be strong at 7.8 billion versus $8 billion in the previous quarters of average. So it's still it's a bit positive surprise from than expected.
What is the positive surprise you said? The order booking.
Yes, and also in terms of revenue.
So order book has come at $7.8 billion. That's the number you're talking about, Omkar, right?
Yes.
Right. Mahantesh, your first reaction, margins at 24.5%?
So let's look at it this way. The revenue on a constant currency basis sequentially is much better than what has been projected. The margins are also sequentially improved, but not to the extent that one would have anticipated. One would have anticipated a 90 bips to 80 bips kind of in margin improvement. It appears to be just about 50 bips. And that's partly because the services the attrition levels are at just 21.3. It was 21.5, if I remember correctly, for the previous quarter. So the attrition has not come down to the extent that the company sounded in terms of their guidance. They didn't obviously give a guidance number, but the general assumption was that the attrition levels would fall down as the manpower intake was steady and stable. So the revenues are good. The order booking is good. The margins have obviously missed, but that's got to do with the attrition, which is still lingered at a higher level. And probably that would mean that they will achieve their margin improvement in subsequent quarter.
Right. But Mahantesh, what is your first reaction? You would say the numbers are in line with some hits and misses?
I think these are better numbers from a shareholder's perspective or from an investor's perspective, simply because you have a special dividend also been announced. That is number one. And number two, the revenue growth has in a way accelerated with the order book also growing strong. So I would reckon that these are very good numbers.
Well, yes, I think what is very good is the fact that the top line growth has come in. Well, yes, what is very good, I believe, is the fact that the top line growth has come in much stronger than expectations. On a constant currency basis, the top line has come in at 2.2%. Our estimates and the street estimate was anywhere between 1.2 to 1.5%. So that is something to really watch out for, and that is something which is good. But the margin expectation at 24.5% is a little lower than expectation. Yes, the expectation was very wide this quarter, around 24.5 to around even 90 to 100 basis point improvement. So at 24.5%. I will call it a bit of a miss, at least as far as margin is concerned, because while the company has delivered on the top line basis, margin is something which is a tad bit of a miss. And even I know while analysts are pegging that $7.8 billion worth of order booking is in the band of 7 to 9 billion that they had guided, but there was this expectation that it could be towards the higher end of the range, so it's right in the middle of the range. Now, talking about the other commentary coming in, Samir Seksaria, the Chief Financial Officer, says that improved productivity, currency support and abating supply side challenges help to expand our operating margin in Q3. This gives them the ability and greater confidence to steer the profitability towards our preferred range while continuing to invest in building newer capabilities to support growth as well as market share gains. So at least for now, they're maintaining the intended band of 26 to 28% on a long-term basis, and the earlier stated guidance was that it will be 25% by the end of this year, and for now they seem to be holding on to that. So maybe they are expecting some sort of improvement to come by in Q4. Even if I look at the other internals in terms of verticals, North America and UK has led the growth with 15.5% growth, but continental Europe is slower at sub 10%, as well as if you look at India business, that was up around 9%. And in terms of industries, it's retail which has done quite well, while BFSI grew at the slowest pace of around 11.1%. Now, why BFSI is important is because that contributes almost 30 to 35% of companies' revenue, so that will be important to track. Overall, in my sense, Pankaj, the numbers are broadly in line with expectation. The revenue growth is something that the street will really give a thumbs up to, but other than that, margin wise, profitability wise, I'm not seeing any big bang number coming in.
Right. Mahantesh, what would you make of the dollar revenue number, which has come in at $7,075 million versus estimates of close to 6,950? So it's a good $70-80 increase than what the street was expecting.
Yeah, so the revenue is something which has come in quite well, despite it being seasonally a weak quarter. There would be furloughs around this time. But then while the revenue has come in good, the order intake has also been strong. That $7.8 billion order book intake compared to 8.1. Now, 8.1 was what was the order intake in the previous quarter, but I would still reckon, given the overall conditions that exist, a $7.8 billion order book intake this time around is quite strong. The only disappointment, like I said, is on the operating margin front. Probably that's got to do with the way rupee has, dollar is once again strengthened, rupee has weakened. and that could have meant a bit of loss alongside the large attrition rate of 21.3.
Mitul, your first reaction to the numbers in terms of CC growth, better than estimate, margins in line with a marginal miss. What is your reaction?
Yeah, overall performance was decent in terms of revenue growth was a bit positive surprise. But there are two, three important parameters where we see that there is a disappointment. Of course, margins we estimated close to 25%, 24.9% EBIT margin, but it came just 24.5, and which is below our as well as street estimate, despite attrition being stable. And most importantly, overall employee addition has been negative this quarter. So number of employees have reduced despite that employee cost has gone up. Geography wise also, this Europe, Asia Pacific, Middle East all are now growing in a single digit growth. So that is also a concern. And in addition to all this, BFSI sector is also reporting very low growth. So these were the key drivers for the company over past several quarters, but now turning slowly negative. Even this order win below 8 billion is also, we are not very positive on that side also. We believe that it should have been slightly better. The situation is uncertain in that situation, decent enough, but it will not support the valuation of this company at this level.
Right. Omkar, any other details that you have that you can start sharing with us? CC growth at $2.2, revenue growth looking in stronger than anticipation. Constant currency was expected 1.4, it came in at 2.2%.
Yeah, definitely. I mean, in terms of the growth that they have done in the CC terms is definitely a well demonstrated execution part at this such kind of a scale, because they have ramped up the deals that they have won in the previous quarter and previous quarters, and demonstrated a well execution part in terms of at such a large scale, and the demand is still continuous resilient in terms of digital transformation and the cloud transformation that they are happening. So it's clearly, I mean, witnessing the dependency on IT services pack of these all businesses going along. So it likely to be sustainable in terms of going ahead, even within the bad times or uncertainties.
Right. Mahantesh, any reaction that you expect in terms of earnings?
See, the stock is already up this today, okay, in today's trading, and I would reckon the special dividend payout of 67 rupees that they have done this time around, making the total dividend payout of rupees 75 per share, is quite a positive. So, and the payment date, incidentally, for this dividend will be 3rd of February. The record date is about another 10 odd days, 7 odd days away from now, from today. It tells me that investors will, if at all, would like to dump the share, will be post the dividend, not until then.
Right. Mitul, you were talking about valuation. Can you tell in more details what does this mean in terms of IT sector as a whole as well, or each company has to be taken case by case?
We need to check each company case by case based on the geography wise exposure, currency exposure, as well as vertical wise. But in case of TCS, it is already trading at 25x. And after this result, we would not see any upgrade in the earnings and valuation at this juncture of high level of uncertainty. 25 seems to be slightly expensive if we consider long-term average being below 20x. So even if we give 10-15% premium to historical valuation, it could be 20 to 23x could be a comfortable valuation. So we believe that after this result, commentary would be very important, wherein if in case any outlook positive towards FY24 or US recession related commentary would be critical. Otherwise, considering the past few commentaries of the Accenture and few other IT giants and headcounts by various Amazon and all other top IT companies, it seems to be slightly negative environment for the sector, and valuation sustaining at premium level is not possible in this situation.
Right. Omkar, but just going into the numbers, what do you think stock was pricing in? Omkar, what do you think the stock was pricing in with the previous few days move? Okay, I think there's an issue with his line. We'll try and dial him in again. Mahantesh, what do you think the stock price movement was pricing in?
I think the stock was pricing in a margin improvement with recovery in the growth rate on the top line front. Very often, investors also look at it from a medium to long-term perspective for companies like TCS and do not take a short-term perspective. And that long-term perspective would tell one that since they have a strong book-to-bill ratio, which is above 1, there is continuing momentum in terms of their sales growth ahead. And this is a critical quarter now that we are entering into for TCS to evaluate what the future is likely to be, because most of the budgets for their clients get discussed around this time, and they get the scenarios that they had been discussing with various clients would have now crystallized into hard budget numbers. So in such a situation, a guidance from TCS would be very important. But like I said, going into the quarter, the strong order book and an improvement in margin was critical to TCS, and on both counts, I would believe that they have in a way delivered. A slight disappointment was there on the margin front, obviously, but nevertheless they did show almost 50 bps quarter-on-quarter improvement.
Mitul, just a quick question to you. You think it's more of numbers-related reaction which will happen tomorrow, but after 2 days, it'll start following NASDAQ?
Yes, tomorrow probably it would be a range-bound reaction based on the mixed result. But post that, and definitely next 2-3 days, other IT giants are also reporting their numbers. So based on that, overall sector movement will be decided after these 2-3 key results comes out. And management commentary, of course, result may be great, but going forward, FY24 outlook in this uncertain environment is more critical.
Right. Mahantesh, also just wanted to understand, generally, TCS would set the tone for others. You think from others now, what sort of expectation would people have?
I think the same trend, margin improvement will be very critical for all the other IT companies because they have all suffered from large attritions.
Mahantesh, the TCS press conference is starting in. Let's listen.
And importantly, a big milestone for us, crossing $7 billion in quarterly revenue in Q3. Importantly, this strong growth has come with increasing profitability. We have registered 24.5% profitability for Q3, and that translates to 14,284 crores in terms of operating profit. Net profit has also grown sequentially by more than 400 crores, getting to 10,846 crores, and at an EPS of 29.64. Our profit conversion or cash conversion of net profit continues to be very strong. We have converted at more than 104% with cash from operations of 11,154 crores. The board has declared interim dividend of 8 rupees and a special dividend of 67 rupees, bringing the total dividend declared in Q3 to 75 rupees. With that, our total payout to shareholders by today will be about 33,000 crores, of which about 28,000 crores will be from what is going to be paid in this quarter. Our performance on both on the revenue side as well as on the profitability side is also reflected in our strong customer portfolio. Our number of customers from whom we make more than 100 million rose by 1 to 59 customers on a year-on-year basis. The growth has been led by our significant investment in talent development through the year. As you know, we had hired significantly in the last year, and that has been the basis of our growth. We have been able to leverage that investment, and our net headcount addition this quarter now is at about 57,000 on a year-on-year basis, bringing our total associate count to slightly under 614,000 people. Our attrition, as we had called out earlier, has peaked, and I'm happy to report that on an LTM basis, now we have started ticking down, coming down slightly lower than last quarter at 21.3, and we're quite confident of this trend continuing and more significant reductions in the quarter ahead. Our focus on innovation continues to be very strong. We have been reporting to you the number of patents applied. Today we have 7,134 patents applied, which is an increase of 738 on a year-on-year basis. Even more importantly, our total patents granted has now grown to 2,694 patents, which is up at 493 patents on a year-on-year basis. I've said this before, but it's very important that our patents granted now is running ahead of 1 patent a day on a calendar day basis even. We are very proud of the tremendous impact that our R&D team is having, both in terms of the dedicated pool of about 7,000 researchers that we have, and even more so in the widespread adoption of the research and innovation culture across the wider TCS population, and as supported by our ongoing investments, not just in R&D, but also in creating the right enabling infrastructure, least of it not being the pace ports that we are continuing to open across the world. Coming to segmental performance, revenue growth once again has been led by strong growth in North America, growing at 15.4% on a year-on-year basis and getting to $3.8 billion in reported revenue. UK is a market where we continue to enjoy strong growth in a very challenging environment, and UK also has grown 15.4% on a year-on-year basis in constant currency terms. Europe, despite challenges, we have been able to maintain a good growth rate with a year-on-year growth of 9.7% in an extremely constrained environment. The segmental performance from a vertical industry perspective has been led by verticals like life sciences and healthcare, which have grown at 14.5% on a year-on-year basis, retail at 18.7%, manufacturing has also had a good quarter, and BFSI has come in at 11.1%, getting close to 2.25 billion in overall revenue terms. So that's the wrap on the numbers for the quarter. In terms of overall demand trends, I think the quarter has been and continues to be about different markets behaving differently. North America continues to remain quite vibrant, and overall the economic stance and customer perspective there continues to be quite supportive, if cautionary. UK is, as I said, a challenging operating environment, but our solutions are finding a lot of resonance with customers, and we are significantly gaining market share in that market and continuing to do very well. Europe is the market where client decision making is getting impacted by the ongoing geopolitical challenges there, and requires close watching in terms of how it progresses through the quarter. Otherwise, we are quite happy with the performance, and thank you all for listening in, and we'll open it up for questions from here. Thanks, Kritika.
Thank you, Rajesh. So we start the questions from the journalists present with us, and then we'll get a couple of questions from the journalists that are joining in online. So we start with Sajid Mangat, BQ Prime. Sajid, 2 questions, please.
Yeah, I'll start with 2 questions. Happy New Year, Rajesh. Can you take us through the demand environment? You spoke briefly about it, but in your commentary, you mentioned about short-term uncertainties. When you look at it from an October point of view and now in January, how have you seen that moving from uncertainty point of view? Is it now you think that it's coming to an end and you have much better visibility on that? Secondly, growth rate. bill to book, I think you have 1 to 1, 1.1. I think last quarter you mentioned 1.2, if I'm not wrong. Is orders coming in little slow? Coming in, you got $7.8 billion, but is there a slowdown which is happening in closing the deals which is there? For Samir, on the margins front, 24.5%. Do you see much headroom as you go into that? The pressure of wages and talent, has it come down significantly for you and for NG? Can you give a bit more on the BFSI space, how it's looking in the US especially? And HR account, negative 2,000 net account. So okay, what went into that?
All right, Sajid. I think the demand and the pipeline is kind of... So overall, demand scenario has not changed significantly. But to be fair, it would take at least a couple of months more for us to actually know what the decision making is. We have gone into December with everybody being cautious. But our view is that this caution has different color across markets. So if you look at Europe, there is obviously a real big issue out there. And it would take some time for this caution to dissipate. And we need to be cognizant about that, and we'll see where it goes. But if you look at North America and UK, which together constitute about 2/3 of our revenue and probably 3/4 of our profit, the environment there is very different, very supportive. North America, while this quarter and probably maybe the start of the year might be a bit cautious, but our own view is that into the year, we should see a fairly positive one because there is no structural challenge there. Of course, this is subject to how the whole inflation scenario plays out. But on our one-on-one conversation with clients, we think that this is a caution that is more in terms of being wary and taking a decision slightly delayed rather than anything comparable to Europe. UK, the environment is challenging, but given the fact that there is no immediate flip there that is expected, customers and industries have moved forward in terms of the decision making and are committing to large scale, sometimes cost transformation, sometimes more structural transformations along the lines of what, for example, the deal that we have announced with a leading telecom provider there. So UK, though the economic environment is bad, the decision making is much more decisive and much progressing well. So we are participating in that. So that's the spectrum of demand that you see. And the pipeline also kind of reflects that. 7.8 billion is right in the middle of our target range of about 7 to 9 billion. So it's not bad in itself. Sequentially, it is down a bit. On a year-on-year basis, it is growing. But if you compare it against our dollar growth rate on a year-on-year basis, it's a tad lower than that. I think that's a good reflection of where the scenario is, that in terms of the overall demand.
On the margins, we started this year at 23.4% after giving a full cycle of increments. And then we have made good incremental progress so that during the last 2 quarters. We are ending Q3 at 24.5, and we are very focused on exiting this year at the same margin which we exited last year at 25%. On the wage front, the supply side challenges abating is definitely helping out, because more so on the elevated expectations of salaries and the backfilling retention expenses. That having come down is definitely helping on the margin side.
Yeah, BFSI has grown well. It's about 11% year on year in this particular quarter. Even by the deal momentum, $2.5 billion of deals is coming from BFSI. Overall, there's nothing to specifically call out, especially, more than what Rajesh had pointed out. The decision making in sometimes, is getting slightly, delayed, but then there is nothing to call out as a worry at this point in time. And going by the interactions that we have with our customers, they're all engaged with us in doing multitude of projects. Some are technology transformation, some are related to regulations like data localization, large-scale payment restructuring, payment re-engineering, those kind of aspects. So, I think there is nothing to call out, whether it is in the North America or UK or Europe. Seasonally speaking, this quarter we had certain furlough impact, more in Asia Pacific than in other parts of the world, but nothing special to call out. It's more or less the same that we typically face in this particular quarter, right?
Was the furloughs higher than normalized level every year?
No, I think it's comparable.
Sajid, you are aware that we made a significant investment in hiring fresh talent last year, as well as the last 2 quarters of this year. And also significant investment in talent development of these people to make them productive now. And that investment is now paying off. Coupled with all the tightening which was talked about earlier by Samir, all of that together basically resulted in a negative headcount. But that does not indicate anything on the demand side. Demand is high. We're just operating it very efficiently right now.
On the absolute level, are you putting more people back on the operations because you had a good, on an absolute level, the bench was high for you?
Yeah. Bench was high for us, and then we were obviously getting also people in the last couple of quarters. So all of that together, we are putting more and more people, making more and more people productive and putting them on project work.
Reema Tendulkar, CNBC TV 18.
Good evening, gentlemen. Squeezing in a lot of questions here, so apologies in advance. Rajesh, first question is on client budgets. Are they closing on time? Is it increasing, decreasing, the reprioritization that we're seeing? Second, on sectors. Last time you had called out PNC insurance, the discretionary spend in retail. Can you tell us any more sectors where you are seeing some headwinds or caution emerging? And just to take forward the statement that you made, looking ahead and beyond current uncertainties, our long-term growth outlook remains robust. How long do you think this current uncertainty, if we are in a demand down cycle, will it be compressed? How long do you expect that to last? Samir, do you maintain exit margin range of 25% for Q4 FY23 that you had guided earlier? And despite a very strong top-line growth, if you could tell us why was the margin expansion capped at 50 basis points this time? And your peak margins were 26.85% post-COVID. Do you have the visibility that you can get back to that? Because you are talking about steering your profitability towards your preferred range. NGS, is there a risk of deal wins going below your range of $7 to $9 billion? In the event of a macro uncertainty? And if you could talk about the deal cancellations, are they closing on time? And Milind, has the attrition has come down after 6 consecutive quarters of an increase, but not significantly. So has the easing of supply side been up to your expectations or a little slower? And if you could guide a little bit more on attrition. Thank you.
All right, we'll try to remember everything and answer it. In terms of vertical industries, I don't think there has been any major change in what we have said. So if you think about it, actually what we had said was that we expect this time that manufacturing will be where the impact will come. So far, manufacturing has held out. It has not been as impacted as we had originally thought, let's say 6 months back. So we need to wait and be cautious about it, but it's a good thing and we are participating well. So far manufacturing is holding out well. BFSI, as NGS said, is growing well. Within that, insurance is slightly weaker, but there's not much to call out on that. And I don't think there is any specific trends there. Retail, when we look into the market, especially if you look at North America, retail sales into the holiday season have been quite strong. Retail profitability has been impacted because of overall cost increases, and they're not been able to pass on all costs to the customers. So the retail industry will go through various transformation initiatives, I'm sure, and we should be able to participate well in that. But net, actually the holiday volumes even adjusted for inflation, has come in higher than last year. So the industry is in good shape. We'll have to they have to work through the cost implications. So net, so that's why. So if you think about it from a structural perspective, with the focus on US as a more stable economy, we think that barring the current extreme focus on the economic environment, structurally most industries are in a good shape, and we are well positioned to participate irrespective of where the focus is, cost or on the growth side of it. UK I already answered when I spoke about Sajid, and Europe is very difficult to call. So as of now, we don't have visibility as to what the final decision on the budgets are. That visibility will emerge later in the next few months as actual project releases come. But what I just explained to you is based on client commentary going into the holidays. So the distribution that I told between.
Client budgets getting delayed in terms of closure?
We'll get to know that as we, no, it is a normal cycle that we get to know of it only during the course of these 2 months, because as you see the project releases and what happens, so towards March, we'll be in a much better position to talk about where we see the pipeline. It's first week of Jan, there's not much of early indications, people are just about coming. So that's the spectrum of,
And how long will the tech down cycle last with the current uncertainty?
The current uncertainty, again, is market specific. The US should resolve itself very fast because we should know quite soon which way it is heading. Europe, nobody knows. And the UK, there is no uncertainty. The medium-term environment is well understood. And companies are moving in that, based on that decisively. So different markets have different time frames.
Coming to margins, yes, we are absolutely focused on exiting Q4 at 25%, which is exiting the year at 25%. And there would be puts and takes in terms of how it plays out, how the quarter plays out. But as a management team, we are absolutely focused on that. Coming to Q3 margins, we had a 50 basis points improvement. And as I mentioned, we have been progressing steadily on our target range. In Q3, we had 70 basis points coming in positive from currency. And additionally, we had 30 basis points coming in from execution rigor, mainly on account of better utilization, realization, as well as reduction in fees to external consultants on a net basis. And this was offset by higher project-related third-party costs and increasing cost of return to normalcy. And I think last question was, when do I get back? So our first target, we'll take it a step at a time. We'll get to 25%, and then we'll try towards getting to our comfort band as soon as possible. On the levers, basically, your question was that will it be only supply side levers? We'll try to pull all levers as possible.
Have all the levers with respect to pricing? Is it becoming more difficult?
Let me finish. Yes, absolutely. See, pricing is always a lever. How much are we able to put on it? And that's a call which we need to take. Pricing, we are getting it on a case-by-case basis. Yes, with the inflation scenario which the world has seen, probably we would have wanted to push it even further. That has not happened, but that definitely remains a lever.
But just to add there, are you getting the new deals at the price points that you want, or is it becoming a lot more competitive and pricing is becoming a challenge even in new deals?
So it's a combination. We are getting deals. The new price points does get factored in. Cost and optimization deals would be competitively built versus sole source deals and the digital transformation deals. We have an advantage.
I think the question on furloughs, I think there is always certain amount of furloughs in certain markets actually fall in Q4 as well. So it's, I think, expected lines, nothing specific to call out, and we're not seeing any abnormality per se over there, right? Second is in terms of mixture of deals and deal pipeline. vendor consolidation and cost and optimization, that kind of opportunities are there, definitely. And it's a mix of both cost and optimization as well as growth and innovation-led deals. And it's the mix of, the percentage of how much of it is in cost and optimization, how much of it is in I think it's along the expected lines and where we want to be, right? We want it to be, and I think it's looking good. There are no concerns per se. There are several large deals in the pipeline, and it's a mixture of it's broad-based across markets, across verticals, right? And nothing to specifically. I think it's more or less in the same levels. I don't think in terms of the number. As well as in terms of the overall value, I think it's comparable.
Following up on that one, actually our realization both on a quarter-on-quarter basis as well as on a year-on-year basis is actually improving. And we expect that trend to continue in the near term also, because pricing takes time for it to get factored into on the realization side. Coming to the larger question, as you know, we don't comment about things, so it's a bit of we'll need to wait and see how this will play out. This year is in a good shape, and as Q4 unfolds and we have better visibility on what the demand trend looks like, we'll be able to at least give you some directional commentary on it. But we'll go back to what we have all said in the last 6 months, and we maintain that medium term in US and UK, we have very strong confidence. Europe is difficult to call, and US and UK accounts for about 2/3 of our business. So we are quite comfortable. And in Europe, we have a very strong presence on the ground. So we should be able to navigate it, and on relative basis, we should be able to navigate Europe well compared to all other players. So we are confident about our ability to play Europe as it unfolds. What the numbers will be, we'll have to wait and see.
No, just the reason I asked you that, Rajesh, in our last conversation, you did say double-digit growth in FY24 is achievable, not just aspirational. So you do stand by that?
I don't specifically, I shouldn't have said things like that because we don't give numbers. It is, if you say FY23, definitely. It's much closer to that.
We'll take all the other questions offline. Anisha, Harshada Sawant, CNBC Awaaz.
Good evening, gentlemen. I just want to understand, Rajesh, a couple of quarters back, digital transformation was very large for you guys, and that's what clients wanted, and that's where the deal flow also came in. Now, as recession fears are picking up, especially in the US, and you say you have no certainty on Europe either, how have the client needs changed? Where is the business coming in from? NGs, a lot of banking clients have said that a lot of banks, in fact, in US have indicated to massive layoffs in the coming quarters. And these are the big banks. How does that impact demand for you? Is that an opportunity, or do you think business could slow down? For me, I'm just confused as to what I should be asking Milind, because he's basically given us an outlook as to how muted the hiring could be. But what is your sense of hiring in the coming fiscal? Is it going to be as strong as it was in perhaps FY22-23, or it's going to taper down because supply side challenges aren't as important at this point in time? And for you, sir, you said higher third-party costs still exist. When you don't have as many supply side challenges, why is work being given to these third-party players, and how soon do you see them tapering down?
Actually, can I add to that question? Why are you looking at a workforce reduction if higher third-party costs are still weighing on your profit margin?
So let me take that first and explain. See, our fees to external consultants has gone down, and if you look at it from an absolute perspective also, it is almost flattish. What I meant by project-related third-party cost is what we call out as equipment and software costs. So it is more linked to project-related hardware software costs, not in terms of external consultants.
No, but also, Harshada, a lot of it comes from on-site, and that's more a factor of how travel opens up. and we need to bring in supply into that local market. And that market still continues to be supply constrained, and that supply side is only opening up now. So a lot of that cost base is actually on-site cost base rather than offshore cost base. So during the course of the year, you should see that coming off, right? Because that supply is easing, but it has time. That answers your question also, because these are different regional ones. Continue. Visas will be there, travel will be there, local hiring there will be, but local hiring, we expect on-site local hiring to ease up, given what has happened in the last 3 months or so. So we should see a substantial or a systematic reduction there.
Are you expecting any significantly higher costs on visas? I mean, I know it's a very...
No.
Nothing significant. Nothing significant at this point in time.
How has client demand changed? It's not digital transformation now, but what is it that the client expects from a company like TCS at this point in time?
It will be a lot more, okay, that was your first question, a lot more balanced in terms of cost optimization, cost-based transformation deals, and that of course varies by market. So we expect this year to be a more balanced year in terms of the nature of the demand also. And you started... Balanced is what I expect. And you started I thought you started your question saying that even Europe, it's not quite, I mean, US is not the benchmark and even Europe is not in. Europe has a problem. US, whether it's a real problem or not, I think time will tell. Our own view is that it's a transient one. There is no structural problem in US, and we are quite positive on the medium term. The immediate short term is difficult to call. We'll have to see what will be. But US, we are quite positive. Europe, something needs to happen for it to turn around. So Europe is a more difficult one to call, but US, we are quite positive about it. Given that construct, the focus, for example, in UK and all are more cost transformation deals, more some cases business transformation also. The US is a much more diverse set. A lot of work is also happening on cloud, because a lot of investments have gone into the cloud. But to realize the promise of cloud, it requires a lot of heavy lift to happen. So though it's not on the headline and it is not in terms of incremental dollar sale of cloud companies, but from actual project work related to cloud, there is quite a lot of work yet to be done. And we are very strongly participating in that. That you can consider whether to call it digital transformation or not, but it is truly transformative. And that will continue through the year, well into the year. So,
okay, overall on the US banking side, right? We also read the same commentary, but then as I see it, the tech spend seems to be holding up, and specifically in terms of the large and deals related to cloud transformation, etc. But having said that, look, certain areas like mortgages or insurance as it applies to PNC, in these areas we see some weaknesses, and consequently some of those reductions that the banks may be planning with respect to how exposed they are with respect to some of those aspects. We see that there is the capital market side of it, the trading side of it is looking good. Customers are actually doing more in those areas. Wealth and retirement space, again, people are looking at technologies to see how they can bring in a lot more automation, a lot more efficiency. So it's a very, very well-rounded thing. And if you take financial services, you have banking, capital markets, insurance. If you put all the three things together, there is a self-balancing effect. If one portfolio does well, another one may have some challenges. But overall, it balances out, and I'm not able to call out anything specifically at this point in time. Except that, look, they are looking at cloud in a big way. They are looking at automation, adopting newer set of edge-oriented technologies, and then data localization, as I called out. Some of those issues are data anonymization, data privacy-related things. Those investments are continue to happen.
Dibangana Ghosh, Money Control.
Ashwata, I need to respond to your question.
Yeah.
I'm sorry if I think we had 500,000 registrations on our NQT we just concluded just now. So, close to, while not giving a guidance on this, but in general, we normally hire 40,000 from the campus every year. I don't expect that number to change in the next fiscal year.
Dibangana?
Yeah, since most of the questions have been asked, so I'll start with Rajesh sir. Sir, from an industry perspective, JP Morgan has already said that they expect the IT growth to come down to 6 to 8% in FY24 as compared to the mid-teens it's right now. So, want to get your outlook and view on that. My question to Milind sir, obviously, I mean, the headcount has gone down this quarter, and this is the first time happening in 10 quarters. Attrition is down. Is this an indication of, demand softening to some extent? And NGS, sir, we have seen the vendor consolidation happening right now, and managed services deals which are coming at slightly lower pricing is something that we are seeing. So, happening more right now. So, will this, impact the margins to some extent eventually? So this is for NGS and Samir sir both.
We make a commentary, then analyst makes a commentary. Then if you start making a commentary on what the analyst commentary is, this will become a never-ending loop. So we have no opinion on any analyst commentary. I told you about our view that in the markets that we are operating in, it's a very diverse outlook right now. And we are constructive on US, we are cautious on Europe, UK we are positive, but we acknowledge that it could be volatile given the challenges there. Within that, we need to go out there and play each ball on merit. And I think what's important for us is we stay close to the customer. The macro view is fine, but end of the day we got to deal with it on a customer by customer basis, and no change in that. We are, our posture is positive. We are not pulling back. We are not cutting, we are not pulling people off the field. We are fully engaged, fully present. We are fully invested from a talent capacity perspective. We had over-invested last year and, benefiting from that. And even if you look at our overall hiring trends, we are continuing to probably at the same level. So we should be hiring in the range of 125, 150,000 people next year. So it's ongoing confidence in that medium-term, long-term view that we have. Short-term, how it plays out, I think we have no opinion on it.
Yeah. See, as far as the managed services type of deals are concerned, I think we have a very large portfolio of clients, right? About 1,200 plus clients with whom we have built a very lasting relationships, and what we work with them is a portfolio of programs. Some are, on managed services, some are otherwise. Managed services, your observation may be right in terms of saying that, look, does it come at a price point which is lower? But it's a question of what value you are giving finally. And managed services by definition also gives us a lot more flexibility, right? To execute a lot more automation that we can do, and a lot more the parameters that constitute the execution of the deal are something that we manage and we execute for an outcome, right? From that basis that, look, overall, over the lifetime of the deal, it has to deliver better margins for us, and that's something that we are very focused at the time of deal construct, and the way that we execute all relates to this. So per se, I think, it's not correct to say that, look, if you really go in for a managed services type of a deal, it will have an impact on overall margins, right? I mean, that's the take on it.
Yeah. like Rajesh said, our investment in hiring fresh grads last year and last 2 quarters of current year, and coupled with very rigorous talent development, that is one parameter. And second is the efficiency in our operations, driving efficiency in our operations, resulting in this negative headcount. It has got nothing to do with demand capture as such.
Ekta Suri, Zee Business.
गुड इवनिंग जेंटलमैन। राजेश सर, मेरा पहला सवाल आपसे होगा कि नंबर्स जो है ये एक्सपेक्टेशन से बहुत ज़्यादा बेटर हैं, तो इन नंबर्स में किन फैक्टर्स ने मदद की, या फिर आपने ग्रोथ आप आने वाले दौर में कहाँ देख रहे हैं? इसके अलावा यूएस और नॉर्थ अमेरिका और यूके, ये भी इन नंबर्स में एक सब्सटैंशियल पोर्शन देख रहे हैं हम इनका। आप आने वाले दौर में यही मोमेंटम देख रहे हैं, या आप इसको गिरता हुआ देख सकते हैं, क्योंकि हम ग्लोबल स्लोडाउन की यहाँ बात कर रहे हैं? और आपकी ऑर्डर पाइपलाइन FY24 के लिए क्या होगी? मिलिंद सर, मेरा आपसे क्वेश्चन ये होगा कि एट्रिशन रेट जो है वो उसमें सुधार आया है, क्या हम इसको एक फैक्टर ये भी मान सकते हैं कि बहुत से जब हम फंडिंग विंटर की यहाँ बात करते हैं, तो जो बहुत सा टैलेंट स्टार्टअप्स की तरफ जाता था, अब एक ट्रेडिशनल जॉब की तरफ ही उसका झुकाव हो रहा है, क्योंकि ग्लोबल स्लोडाउन की बात हो रही है, स्टार्टअप्स के बाद फंडिंग की कमी है, तो ये भी क्या एक फैक्टर हो सकता है?
Right, I'll start. In terms of where the demand has come from, where the outperformance has come from, we have had good and strong performance both in US and UK, and also markets like India, so which has also done very well for us. So it has been an overall good performance. If you look at in terms of the nature of that demand, it has been quite a lot of business coming from transformative engagements. Cloud transformation continues to be a big driver of the demand. As I said, while overall incremental cloud consumption might be challenged in the overall market, we are seeing in our client universe long-term commitments to cloud transformation journeys continuing, and we are participating very strongly to actually execute on those cloud transformation journeys and to make them real, and to to deliver the business cases on which these transformations were originally predicated.
Is that the digital investments or digital play that the banks have in India is probably the biggest and nicest in terms of the outcome delivered in the market, even when you compare them with respect to the global banks, right? So the whole world is looking at the digital banking and the digital payments and the whole India digital stack that has evolved in India. So in that context, I think a lot of investments are happening on cloud, artificial intelligence, machine learning, and data related, analytics related investments, and also integrating a lot of startups and fintechs that are emerging from the Indian market, the Indian ecosystem. Metaverse will be a pilot at this stage, but I think it will take some more time before that is put into productive banking use.
Thank you.
Thank you.
Ramita Mazumdar from Economic Times.
Hi, hello gentlemen. I think my first query for Rajesh will be, in terms of, because we have talked about large deals still being in the market, are we going to see the large deals that come into the market in 2023 to be more on the renewal side, or will we see any net new, absolute new deals coming in over here? Also, how much of an emphasis are we going to see purely on, the lowest pricing when it comes to going for these large deals? That is for you. For NGS, I have in terms of the new business structure, if there's anything you can share in terms of how it has been doing, and also how much of the cloud growth that you're talking about, how much of it is flowing in through these new operational structures, especially enterprise growth and the business transformation group. And for Milind, if you could give us the number of freshers that have come in this time. And also, I wanted to understand, is lateral hiring on a pause right now? Is that something we are going to see for the next couple of quarters as well? So that's all.
Right, Ramita, I think the best way to answer it is, if you go back to the deal that I spoke about in UK, it's a deal with British Telecom that we announced. If you look at the construct of the deal, on one side, what we are doing is we are actually taking over the entire maintenance of their existing estate and freeing up their capacity to drive a very accelerated transformation on the digital and cloud side. We are also participating in helping them, but our domain knowledge, our contextual knowledge is actually giving them the confidence to be able to move their SMEs onto their transformation journey. Now, you could look at this deal in both ways. Is it, is it about an existing set, or when you look at it in its entirety, the transformation that is actually going on is as much a transformation that is being executed on the movement into the new architecture that they are envisaging, and us being able to play a role in helping them A, free up capacity, and B, participate to make sure that this migration happens and transform this estate in line with that ongoing migration. These kind of complex structures will characterize the deals that we expect in the coming future, and those are fairly integrated deals. It has got a transformation element, it has a cost transformation element, it has a very strong engineering focus, it has a very strong operations and execution focus. So that's the kind of large deals that we expect more and more to be unfolding as large enterprise, large workloads go down the path of transformation. So each deal will have its own, what should I say, characteristics, but broadly you can think about them as heterogeneous deals, which include all value drivers in there, rather than think of them as one single value driver driven deal. Yeah. No, these are, so this is being structured as one single integrated one, right? So because it's important for them also to have a partner who can actually handle that scope and scale together, so that we are like completely tied at the hip, because the success of the transformation depends on the success of how this aspect of it is being done, and their confidence in our ability to do it, so that they can move forward into what they are trying to do. Yeah.
And in terms of cost, is it like...
That's why I said, so if you look at this, there is a cost transformation involved, because the legacy cost base needs to be transformed to be able to support the transformation. There is an architecture transformation involved to be able to migrate into the new architecture. And there is a complete new, by the time they are done with it, they hope to have an architecture which will lead to business transformation, because they should be able to decouple their functionality and services inside that stack, so that business model transformation can happen. So it has the full spectrum of transformation, from cost all the way to business model.
The 13.5% plus, growth that we have achieved in this quarter is largely pivoted by the demand on the cloud and related areas, related technologies. Okay, so in that sense, that whether it is on our own private cloud or on the hyperscaler cloud, the demand on the cloud side has been quite good, right? As Rajesh articulated, it's not just the cloud, right? It has to bring a lot more of our offerings together, right, in anything that we do today, right? For example, the TCS Interactive on the front end side, that experience design has to come in. The cyber security thing that has to be pitched in, plus the analytics and data related transformation need to take place. The automation and the intelligence layer will have to come in. So several services lines all have to come together to stitch together this large transformation, a large work that we do. And whether it is large or small, invariably, whatever I said, they are all becoming fundamental to the architecture in which, you deliver any system today, right?